PayPal stock is going to the moon. As the kids say, it's going to the moon. They still say that, right? It's up 10.35% today, $98 a share. And this is a company that's had a rough go over the past year. It was at $308 per share. Now it's traded down all the way to $77, $80, but it's having a revival. And now a lot of people are looking at this last earnings report and they're saying, hey, is now a good time to maybe jump back into PayPal? Maybe it sold down too much and now it's time for investors to jump back in, maybe make some good gains. And the earnings report shows promise, shows a lot of promise. This was much better than expectations. We also have news that Elliott is an activist investor firm that they took a big stake in PayPal, about $2 billion. And it's led by Paul Singer and I believe his son. But Paul Singer is notorious for being very intimidating. He has what they call tough love. He will buy stake in a company and he will strangle value out of it. So now he has control of PayPal and they're working in line with PayPal to unlock value by cost cutting and all different measures. So we have a lot to get to. Let's go ahead and jump right in. For those of you not familiar with this channel, I track my real portfolio every single week, week by week, to give you transparency into both my successes and my failures. And I do individual stock picking where I invest in 9 or 10 different companies. All of them I think have great stories. Now, this portfolio is called the Story Fund, which don't be mistaken. The story of a company is not just the narrative. It's not just the talk of the company and ignoring fundamentals. The story includes the valuation and the fundamentals of the company in combination with the narrative, with how you think things will evolve qualitatively over the next 5 years. That encompasses the story of a company. So when I look at the Story Fund, what I'm looking for are companies that have great stories, companies that will grow over the next 5 years. They will gain market share. They'll grow free cash flow and all of that good stuff. And I compile a list of companies in this portfolio on the hopes that it will outperform the S&P 500. Not every one of them is going to be successful. The best stock pickers in the world had a success rate of around 60%. Peter Lynch lost a lot of money on around 40% of his stocks, but he made so much more on the other 60% that overall he made a lot of money and beat the stock market. So not all of these are going to be in the green all the time. Some of them are going to be losers, but the goal here is that I'll have enough winners to compensate for the losers. Now, I do something a little bit different here as well. I track this portfolio against the S&P 500. We can see how this looks right now. My portfolio is in blue. This is since inception, and then the S&P 500 is in red. And this is based on time-weighted returns, and it also includes my inflows and outflows of cash. So anytime I deposit money, it's as if I bought the S&P 500 at the exact same time. This is what it looks like so far. We had a huge gap between us and the S&P 500 a couple months ago, and that is being closed in. The reason why is when the market gets really defensive, the market moves away from these type of companies. That's just how things go. When the market pulls back and becomes fearful and scared, investors move to very defensive companies. When the market gets a little bit bullish and they want to buy, this portfolio is up way more than the S&P 500. It's up 3.04% today. For example, the S&P 500 is up 1%. So on the day, we're up quite a bit more than the S&P 500. Now, I'll continue to track this week by week. Also, if you're new, keep in mind that this is one of 2 YouTube channels I have. On my other YouTube channel, linked in the description below, I track a dividend portfolio. So if you want to see a more steady, slow compounding approach and not all of these exciting growth companies, you can follow that dividend portfolio as well. I do in-depth analysis on companies there. Now, having said that, I'll continue to give updates every single week. I'll explain my buys and sells, if I make money or lose money on these different companies. So if you want to follow along with this journey for free, you can subscribe to the channel. Now, let's go ahead and move on to PayPal. We just had their earnings report. And before I jump into it, this is a great earnings report, by the way. But before we jump into it in detail, I just want to give some background and context to what's going on with PayPal. About a month ago, a firm called Elliott Investment Management, a large firm, purchased around $2 billion worth of PayPal shares. And this is a activist firm. It's ran by a guy named Paul Singer, who is notoriously, he's very intimidating guy that will buy large stakes in companies. And since he's an activist investor, he'll try to implement change. Now, Paul Singer is someone that if you get a phone call saying, Paul Singer just bought $2 billion of your company, You're nervous now. You're nervous about your job as an executive, as a board member. You're nervous as an employee. Are they going to do pay cuts? Are they going to do layoffs, right? You're nervous because he enacts a lot of forceful change on companies that they don't necessarily want to do. They're fat and comfortable. They've been in their little groove. They've been just coasting along. And here comes Paul Singer and his son, Elliott Management. They come in and they say, time to get into shape. Time to really put the pedal to the metal and get this company moving. And some companies enjoy this, at least they say they do. Some companies do not. Either way, this is what's happened. And it's arguable of whether or not this is overall a good or bad thing for the company. In some cases, I think what Elliott has done has been good for companies. He whips them into shape. In other cases, I think it hasn't been good. He's looked at as a vulture that squeezes value out of a company temporarily. He gets some quick gains and then he exits his position. So it depends on case by case basis. But if you talk to Paul Singer, he would say, what I'm doing is good for the shareholders. I'm making it so these companies are more efficient and they make more money for the shareholders, and it's a better thing overall. That's what he would say. So that's what's happened. Paul Singer and Elliott Management bought a large stake in this company, and analysts are cheering it because they're saying that PayPal needed some of this tough love. Now, what's happened with this? Let's go ahead and look at some highlights from their earnings call here. This is going to be tough to read. I'll read it for you. It says, this is the management of PayPal explaining their relationship with Elliott. They say, we are leveraging our enhanced scale coming out of the pandemic to drive meaningful reductions in unit costs across our supplier base. As a result, we realize our target of approximately $900 million in savings in 2022. So they already say that this year, with their cuts, with their expenses going down, they're going to be saving $900 million. Just shy of $1 billion in cost cutting, which is contemplated in our reset guidance last quarter. We anticipated this reduction in our cost structure, and it will result in at least $1.3 billion of cost savings in 2023. So this is something that PayPal says they were already planning on doing, but I'm assuming with Elliott coming on board, this is the timeline was probably pushed forward. I'm guessing Elliott came in and then PayPal said, all right, we're going to do a lot of cost saving. We're going to try to satisfy Elliott Management. With the result of operating margin expansion next year, these cost savings are not one-time in nature and will continue to benefit the company on a run rate basis. This is part of the great news of PayPal. It's the fact that they're trimming off the fat, so to speak, to use some of a dehumanizing term. But really what it means is that they fire people that aren't entirely necessary to the operations of the business. They cut down costs that aren't totally necessary. They focus on cost structure, not just endless expansion at any expense. They also say, we expect operating margin expansion beginning in the fourth quarter of this year and continuing into 2023. Furthermore, they are directly asked about Elliott Management and their involvement in PayPal. And Daniel here, the CEO of the company, Daniel Schulman, says, I'd like to take the opportunity to provide some color on the discussions we've had with Elliott Investment Management. First of all, the discussions we've had have been both constructive and collaborative, and we appreciate the partnership we've built with Jesse Cohn. I think he's the new one running this joint, and his team. So they're saying that they welcome it. It's been collaborative and constructive. Really, they don't have a choice. Either they can be against them and they can try to fight any type of change that Elliott's promoting, or they can just say that we're going to work with them. It's going to be great. And that's what the management has done. I think it's the right decision. Unless the activist investor is doing some things that are incredibly harmful to the company, in most cases, I think it's better just to align with them, do some cost structure changes, some cost cutting, and make the company run more efficiently. Now, he continues on saying, our discussions are focused on operational improvements, revenue generating investments, and capital allocation, and they are consistent with our short and long-term objective plans. We've been working on a number of initiatives such as improving profitability and return of capital. Return of capital means buybacks or dividends. Return on capital means they invest to make more money for you. So they're going to improve the amount of capital they return back to shareholders. We're pleased to announce the following: approximately $900 million in cost savings in 2022 across our operating and transaction expenses, with savings potentials of at least $1.3 billion of fiscal year 23. an invigorated capital return program, including 15 billion share repurchase authorization, full evaluation of capital return alternatives. So they're looking at different alternatives to returning capital back to the shareholder. Maybe PayPal will be a dividend paying company sometime in the future. Right now, they're saying that they're sticking with buybacks, and they authorized $15 billion in share buybacks, which is something that shareholders, of course, want to see. Another thing that PayPal noted in their most recent call is an overall change in strategy, and I think this is worth highlighting. Last year, PayPal said it was considering adding stock-based trading capabilities to its app. The company has since abandoned that push as part of its focus on reducing costs and keeping headcount in check. So they were going to come out with a stock-based trading app like every other fintech company, right? One that you can go and buy and sell stocks in. And they said, nah, that's going to require too many employees, more stock-based compensation, more money outflows to build something that is very common amongst these fintech companies. So I like that they actually stayed focused. They're not going into the stock-based trading because that's something a lot of other companies have, and PayPal is going to save more money that they can return back to you, the shareholder. They also said that they're focusing on their core value proposition, their core business, which is it will deepen its investment in its online checkout button. That's where they make the real money, payment volume, and revamp the Venmo app. It plans to allow teenagers to sign up for Venmo. So they want a younger audience in Venmo. They want to revamp their checkout button. If I was a PayPal shareholder, I'd be happy about these decisions. I think management's very focused on growing their core business. So now that we have a little bit of background and context and what's going on with PayPal, let's go ahead and jump into the numbers. Before we get into the earnings report, I have to quickly mention today's sponsor of this video, which is FTXUS. They have their brokerage now available to everyone, so you can sign up and try it out today. They just announced how they're going to run this brokerage. Most of them offer free trades, but those trades really aren't free, all things considered. Most of them do something called payment for order flow, where they sell your information to someone else that kind of front runs the trades. FTX does not do that. They charge you a tiny amount per trade, either 0.05% or 1 penny per share, which means if you bought around $10,000 worth of Amazon stock, you'd be charged around 80 cents. So that's the amount that you're paying per trade, but they do not do payment for order flow. So that's the balance that they've struck. They want to be very direct with how they're monetizing the system. No payment for order flow. You can buy and sell fractional shares, and they don't charge you anything for fractional shares. And it's a pretty clean interface. I've already made $500 on Amazon so far. My P&L right here, I'm $500 in the green. 27% return just over the past month. It's part of FINRA and SIPC insured. Sign up for an account now. There's a link in the pinned comment below. And when you sign up, be sure to use the referral code Carlson. That lets them know that I sent you. It helps out the channel, and it gives you $10 upon your first $100 trade. Let's go ahead and jump into the numbers here. We have the earnings report pulled up. They say that they delivered solid financial results. We'll all be the decider of that, PayPal. You can go ahead and claim that, but let's go ahead and look at the numbers here. Net revenues of $6.8 billion, growing 9% and 10% on an FX neutral basis. So foreign currency exchange is being taken out of these numbers, and excluding eBay, the revenue grew 14% on a spot basis. They add that in there just as a little tidbit of information to show you the impact of losing eBay as a customer. They would have grown by 14%, but they're losing this massive customer called eBay. You can see the impact that eBay has over PayPal. It made it so they grew by 5% less. So that's just something to factor in there. They say the GAAP EPS of 29 cents compared to $1 in Q2 of 2021. So their EPS went way down from $1 to 29 cents, and non-GAAP EPS of 93 cents compared to $1.15 in 2021. So the non-GAAP estimate's way different than the GAAP estimate. Operating cash flow of $1.5 billion. That's really good, growing 12%, and free cash flow of $1.3 billion, growing 22%. That all seems decent. We have the total payment volume here of $339 billion, growing 9% and 13% on an FX neutral basis. These numbers look decent. Overall, good report so far. Their highlights are on a table here to show them very simplified. Net revenues grew by 9%. Operating income decreased by 32%. Earnings per share went down. They say 129%, but it went down to 29 cents per share in the red actually. So it depends on the way that you do the EPS calculation, GAAP or non-GAAP. That'll change the outcome there. In their key operating and financial metrics, total payment volume grew, net revenues grew, the non-GAAP EPS and a year over year went down from $1.15 to $1 or to 93 cents. So you see it right there. And then you can see the change in their operating cash flow. So this looks okay. Now, if we pull this up, here's my thoughts on PayPal and their actual fundamentals. The company's a $100 billion company trading at a 22 forward PE ratio. It has a good free cash flow yield trailing 4%. So on a free cash flow basis, this company does not look overvalued. To me, it looks like decent value. The PE ratio it's a little bit higher than what I'd like. I'd like it a little bit lower, but it's come down a lot. The people buying this company a year ago up here, along with the rest of the market, they just got crushed because it's come down 55%, 60% from its highs. PayPal is one of the companies that fell out of grace along with Meta and Netflix and so many other companies during 2021. Let's go ahead and look at some other trends here. This is the revenue growth of the company. You can see it's a consistent revenue grower, something that you want in any single company that you own. Unless you're investing in a turnaround, you want every single company you own to be growing revenue at least to some degree. The EBITDA is a little bit more concerning. The EBITDA showed the unnatural spike in 2021 and it's starting to come back down. That's a little bit concerning of a trend there, but it seems like they're trying to reaccelerate it now. And then we have the free cash flow, probably my favorite chart. And I want to switch this over to free cash flow per share. The free cash flow per share is increasing over time, but not at the rate that I'd like to see from a company like PayPal. It's just a little bit slower than expected. We can see this more clearly in the annualized view. Here's on an annual basis. This looks a little bit better because at least it's increasing since 2015. But since 2018, they went from $3.94 in free cash flow to 2021, $4.63, which is about a 17% improvement. So they're growing their free cash flow per share, but very slowly for a company like PayPal. You should want to see this increase dramatically over time. Now, if we compare this free cash flow per share growth of PayPal to another similar company, Salesforce, it's not a fintech company, but they're both tech companies. You could invest in either one of them. Let's take a look at Salesforce's year-over-year free cash flow per share growth. And this is really the amount of cash flow the company's producing. This is the bottom line, the most important metric we should be looking at. Over that same time period, from 2018 to 2021, Salesforce's free cash flow per share went from $3.08 to $4.51. That's a growth rate of around 78% compared to PayPal's 17%. And if you look at this on a broader timeline, almost over any timeline, it's growing its free cash flow per share a lot more rapidly. So I'm not saying that this is the only metric we should look at, but it's just something to keep in mind. PayPal is growing its free cash flow per share just a little bit slower than other alternative companies like Salesforce. Now, aside of that little concern of the growth being a little bit slower than I'd like to see in their cash flows, I think overall the metrics are moving in the right direction. The company's growing, the stock price has come down to a much more attractive point. I actually think that it's attractively valued at this point. I think that there's more upside than downside, even after today's bump. So if you're looking at PayPal, overall, it's a great company, great stock, moving in the right direction, has solid fundamentals. It does generate free cash flow. I do believe that Elliott Management and the team at PayPal, they're going to improve their cost structure. They're going to save money. They're going to return more money back to the shareholder, which I think is a good path for them. Now, I don't plan on buying this company for a couple different reasons. One of which is that I don't love the product. PayPal and Venmo are okay. I do use Venmo from time to time, but I don't like PayPal as a payment processor. I never use it for online shopping. I'd rather use my credit card or Amazon or basically any other payment processor. And in terms of actual fintech companies, I'm asked about fintech companies all the time. People say, Joseph, what is your favorite fintech company? Which one do you think is the best? Out of SoFi and PayPal and Block and all these different companies, what is the best fintech company? My answer is always the same. This one right here. This company named Apple is the best fintech company in the world. They have the best fintech products, and Apple can leverage its enormous ecosystem to compete with standalone fintech companies, I think, fiercely. They have Apple Pay, which is being more and more commonly used on websites all across different retail stores. They have the buy now, pay later, which is a huge competitive advantage with Apple because they don't need to go to a bank to finance it. Apple is a bank. That's a massive advantage. Their cost of capital is much lower than fintech companies or other financial institutions. They also have their credit card with MasterCard. They have a lot of things they're doing in the fintech space that I think Apple has an inherent advantage. So when I look at investing in a company like PayPal or Apple, and I can pick them up at relatively the same price, around the same PE ratio, Apple's even cheaper on a free cash flow yield basis, I much prefer Apple. I think it has a stronger moat. I think it has better qualities, a better ecosystem, and I think overall it is a better fintech company. So that's my thoughts on PayPal stock and fintech companies in general. If you like this type of analysis, make sure to check out the Patreon. There's a link in the description below. As part of the Patreon membership, you get access to a Discord community where we have literally thousands of active members. You get access to Qualtrim, the suite of software. You get access to hours and hours and hours of exclusive content as well. I'll be doing another hour-long AMA where you can ask me anything. So try that out if you haven't already. There's a link in the pinned comment below. It's a free trial. Give it a shot and let me know what you think.